Good day, everyone. I'm Gangster Trader, and on today's episode, we're going to be talking about risk management. Now, what is risk management? By definition, risk management is controlling how much you lose when you are wrong. Why is that? It is simply because losing trades or experiencing losses are part of the game, a part of the business. All right. So, reality check. You can win only 40 to 50% of your trades and still grow your account if your risk is right. So this expression usually take a lot of traders years to understand. A lot of traders learn without any mentor. So these things will take them time, a very long time before they can understand that actually if you can win only 40 to 50% of your trades, uh, you would always grow your account if your risk is right. So how much should one risk per trade? What's the appropriate risk? What's the appropriate percentage one should risk per trade? So personally, I risk depends on the account size, right? I risk from 1% to 3%, and I think this is like a standard advice. I've been trading for the past 6 years now, and I can tell you that using a risk from the range of 1 to 3% would make you stay longer in the game or in the business. All right. So, for example, if you have $100 and you're risking $3 per trade, now this is what will happen. If your account is $100, all right. If you're risking 1%, that is $1. If you're risking 2%, that is $2, and if you're risking 3%, that is $3. Conversely, if you have $500 account size, if you are risking 1%, that is $5. If you're risking 2%, that is $10. And if you're risking 3%, that is $15. All right. If you have $1,000 account, if you have $1,000 account, if you're risking 1%, you're risking $10. If you're risking 2%, you're risking $20. If you're risking 3%, you're risking $30. So ask yourself, how much in this range, how much are you willing to risk? That is one of the most important questions to ask yourself. All right. Three, how risk reward ratios will save you. So if you risk 1 to 3%, yeah, you only need you only need to win 3 to 4 out of 10 trades to be profitable. That is fact. Speaking from experience, right? So, for example, if you're risking $10 to make $30, that is simply 1 is to 3 risk to reward ratio. If you're risking $10 to $3, that's equal to saying you're risking 1% to make 3%. So if you have 3 wins, that is $90. All right, that is 90 clean. If you have 3 consecutive wins, that is $90. If you have 7 losses, you would have a loss of $70. You are still up $20. You see how risk management will save you. But the issue with a lot of us traders is we lack the patience and the time to see this thing through. All right. So we when we lack knowledge, over time we start to blow up accounts, and over time we now come up with the idea and the notion and the belief system that forex is scam. When in reality, the problem is your risk. You lack the knowledge of risk management. All right. So number four, never move your stop loss. This part I can tell you for free. If you have a system, never move your stop loss should be part of it. Like it should be a clause in your system. So over my time trading, I've opened hundreds of positions, and I can tell you that moving your stop loss is compromising your trade, compromising on your trade, and it's almost like for me it's the same thing as over leveraging on your account, because these things will kill your account. If you open a position, let your stop loss be where it is till the trade runs its course. So you might feel that your trade is running, it has gone 20-30%. Because of fear, you now move your trade to close, to break even. Leave your stop loss where it is. Let it be there until your trade runs its course. All right, stop trying to move your stop loss. At the end of the day, you'll find out that if you keep moving your stop loss over time, you'll find out that you're not even making money because um you're either closing to break even or you're closing on a loss. Sometimes price will test you. Price will usually go to your stop loss and dance around before it actually starts to move. All right, so in the long haul, it's damaging your account. All right, so this is one mistake that a lot of beginners make moving stop losses and praying. So the thing with professional traders is we accept small losses and we wait for the next setup. We always do. We understand these things. All right, so we have a bonus tip for you all. Predetermine your risk once you place the trade. You are done managing the loss, right? So in summary, risk small, stick to your plan, protect your capital first, and profits will come later. All right. So let me take you guys to one practical example here. Let me show you how to, you know, let me show you how to know the lot size to use to determine the percentage you're going to risk on your trade. All right. All right. So as we can see, we're in a downtrend, right? So quickly look for a sell setup, and let's analyze this quickly. So we're on the 4H time frame, right? So we'll just look for major structures. After this break here, this episode is not about market structure or anything. It's about risk management. But let's just quickly take you guys over this. So after this break here, we have this next high here. So let's see how price plays. We're looking for a sell setup, right? All right. Let's see. So, as you know, this is our new high just here. This is our new high just here, right? So, and this is our new low because there's been a break of this structure, all right? This is the 4H, so this is our major structure. These are major structures. We call it major structures. There are major structures and there are minor structures. Minor structures are the internal structures you see on the lower time frames. Okay, so let's hope that price does this here, tap on this other block and reverse. So if we do that, if we see that, we would continue. So yes, let's mark our other block. This is a possible other block here. Okay, let's just mark this here. Let's not overcomplicate it. All right, so let's watch price. Okay. Okay. Okay, cool. Let's take this back a little. After this tap here, all right, let's go to the 1 hour time frame. Usually I use the 15 minutes time frame for my analysis. All right, so basically you might want to, the reason why you're skipping to the lower time frame is to look for confirmation, like probably a change of character, yada yada yada. But if you're experienced like us, you know how to maneuver your ways around this sort of setup. All right, so let's just go straight to the point by setting our stop loss here, all right, above the other block. And this is another part I've always wanted to discuss. So basically, once you have put your stop loss, there's a lot of things that this SMC traders do, this ICT and SMC traders does. They like to put their stop losses down all the way, targeting 10 pips, 20 pips. Once you understand structure, nothing concern you on 10 pips again. Nothing concern you on 15 pips or 20 pips, take profit. All right. So once you can get a 1 to 3 risks to reward, you are good. So you target a 1 to 3 risks to reward, and we are good. All right. So fortunately, it's this next swing low. I think it's still a few pips below this next swing low. All right. So now this is the most important part of this video. All right. So a lot of us newbie traders don't know how to calculate our risk, like in the sense of you don't know how many percentage to risk. Now I said from 1 to 3%. Now if you want to know how to, on your small account, you want to know how to know the lot size to use, the right lot size to use to get the percentage. This is how you do it. This is a little technical, so I'd like you to drop whatever it is you're doing and concentrate fully on this. Now, there's a formula to this, finding the lot size to use in relation to the stop to the percentage you want to risk. All right, so the formula simply is lot size equal to risk in dollars divided by the p value, which is 10, is a constant number, which is 10, times the stop loss in pips. All right. All right. So say we had $100 account. All right. We had $100 account, and we want to risk 3%, right? Which is $3. So we want to risk 3%. Okay. So given our formula is what? Lot size, which is LS, equal to risk in pips, which is 3%, divided by pip value, which is I told you 10 is a constant, 10 times stop loss, all right, which is 37. If we look here, you see that stop loss is 37. So I want you to this is very, very important. All right, the one thing I want you to do first is to multiply. I want you to first multiply the denominator, all right, which is 10 times 37. Okay, so 10 times 37 is what? 370. All right, so we have ls equal to 0.008. All right, now in math they'll tell you 0 points, because we know this is MT4, and MT4 doesn't allow more than 3 digits. So this 8 here, we'll transfer this 8 here, and when we transfer the 8 here, to turn to what? 0 what? 1. So this is the lot size you would use if you want to risk 3% of your account size. All right, so there's also a formula for checking precisely the amount you're going to lose. All right, so that formula basically is the formula basically is your lot size, which is 0.01, times your lot size times pips, which is 37 pips, times your pip value, which is 10, and here you have it. You're going to lose $3.70 on your $100 account. All right, so conversely, if you want to check how much money you would make on this your $10 account, so the profit target here is 111. All right, let's go over it again, but instead of your stop loss, which is 37, we'll put the figure for our take profits. All right, which is 0.01 times p value, which is 10, times 111. So basically we're going to be making $11.01 on our $100 account. All right, so let's move on to the next example. All right, say we have a $500 account, and we want to risk 3%. All right, here we want to risk 3%, which is $15. All right, so what are we going to do? We're going to, now we don't know the lot size that will make us lose 3%, right? So we're going to bring out our lot size. The formula SL equal to risk, which is 3%. Okay, should we use something different? Let's use 2% risk. All right, so let's use 2 divided by p value, which is 10, times stop loss, which is 37. All right, so we have ls equal to 2 divided by 370 LS is equal to, that is lot size, is now equal to 2 divided by 370. You have 0.05. So basically, if you want to lose 15%, if you want to lose $15 on your $500, 0.05 is the lot size. All right, so back to our trade. We want to risk 3% on our account. All right, and so the trade is running. The trade is running. Once this trade hits SL, if this trade hits SL, we lose $3. If we win this trade, exactly, we hit TP, we make $11. That is how you calculate your risk to reward in trading. So this is the end of this episode. I will meet you in the next episode.